The Alpha Horizon. Thinking different. Acting aware.
Hello and welcome to the latest edition of the Alpha Horizon podcast from Algebris Investments. My name is Douglas Branson and I'm very pleased to be joined by our equity portfolio manager Mark Conrad to hear his thoughts about the specific area of the asset class that he covers and to address some of the thoughts that investors are raising with us. So to set the scene, equities have performed strongly in the last 10 to 12 years in reaction to the enormous support provided by central banks globally. The S&P 500 index has averaged over 13% per annum since 2010, with only one of those years, which was 2018, having been a negative year, and it's up over 100% from the lows of March 2020. What we want to have a look at is where do financial equities fit into this incredible run of performance from equity markets. So Mark, thanks very much for your time and for joining me.
Hi Doug, thank you for having me.
My first question really is that investors have shied away from financial equities for what feels like an awfully long time now. Can you please outline how this has been for you as a fund manager focused on the sector? And also, how has your frame of mind changed over the last 9 to 12 months as the opportunity has developed?
When we started Algebris over 15 years ago, financials was the hottest sector in the market. There were many global financial funds at the time running multiple billions of dollars. Despite not having a track record, on day one we were able to raise $700 million and were the biggest sector hedge fund launch up to that point. It was a mega bull market in financials. Everyone wanted in, which is amazing because we were just 2 short years away from one of the biggest financial crises ever. So now, fast forward a decade and a half, pretty much all those global financial funds are gone, and many of our top competitors in the space have left the industry. Very few brave souls want to touch the financial equity sector. The AUM of the largest financial funds is a tiny fraction of what you see in the healthcare or tech space. I find this situation very analogous to where we were in the tech sector way back when we were starting in 2006. It was years after the dot-com bust, but no one wanted to be involved in tech, and tech funds were having a very tough time raising money. And of course, that was the ideal time to be getting invested into the tech sector. I think that fits up very much with where we are today in financials. It's an unloved, even hated sector, but fundamentals are highly attractive. In terms of the last 9 to 12 months, there has definitely been a slow but notable turn as some of the big macro headwinds that we have been dealing with for years in the financial sector are now shifting to tailwinds. Inflation, regulation, asset quality, they've all inflected better for the financial sector and banks have started to outperform. This is reflected by growing AUM in strategies that primarily invest in financial equities. We think the trajectory of the sector is looking very positive and investors are only now just starting to take notice.
Understood, and that's very helpful obviously to set the scene. But given how extended equity market valuations are currently and the recent volatility we've seen, why should investors be less worried about financial equities as opposed to other areas of equity markets?
I do think this is a fair question because the financial sector has traditionally traded with a fair amount of beta to the equity market. And I do agree that overall market valuations are high, especially in markets like the US. However, it's important to note 2 key points. First, valuations in the financial sector look completely different from the broader markets. In Europe in particular, bank equities are trading at roughly 60% of the market multiple, which compares to a historical range of 60 to 80%. So we are at the very bottom of the range right now. And even if we take the market out of the equation and look at how banks are valued today versus how banks have been valued over the past 2 decades, they trade at a discount to the historical average, which is true only for one other industry in the market today. We focus on value, and many of our holdings trade at deep discounts to tangible book value and trade on 6 to 7 times earnings with 7 to 8% dividend yields. These are highly attractive on an absolute basis and at a huge disconnect to the extended valuations you see in many parts of the equity and bond markets today. The second point is to understand why we have seen some of the recent volatility in markets. In our view, it is primarily due to a reassessment of the transitory inflation debate. The whole world made money for a decade crowding into long-duration assets, whether they be corporate credit, loss-making growth equities, or negative yielding sovereign debt. And now it's starting to look like inflation may be higher and more persistent than previously thought. This has implications for monetary policy and the yield curve. The financial sector is one of the only areas of the equity market which benefits both from a rise in real interest rates and inflation break-evens. Banks in particular benefit doubly as their earnings power goes up with short rates and their PE multiples tend to move higher with long rates. We saw this in the US in the last Fed hiking cycle a few years ago, and we could be on the cusp of another cycle today as more and more central banks start to tighten policy and yield curves globally shift higher. So as investors start looking for the exits on some of those long duration trades, they will have to rotate elsewhere. Financial equities can serve as a hedge versus rising rates and inflation, while also providing a high and growing dividend. There are very few assets in the world that can do both at the same time.
Thank you. Now, we run a global financial equity fund, so can you outline what the global opportunity is for financial equities? And perhaps you can highlight the relative merits of the sector for the US, Europe, and Asia. And then maybe also comment on whether or not there's an opportunity in emerging market financial equities.
We believe there's a clear global opportunity within the financial sector given the diversity of different geographies and operating conditions. The European banking sector is at an inflection point following a decade of restructuring and balance sheet repair, which the market has yet to fully realize. This can lead to upside potential looking forward, particularly as the European economy continues to reopen and inflation expectations are starting to rise after years of being suppressed. The dividend yield for this sector next year is looking to be 6 to 7%, which is significant for a sector that historically traded at around a 3.5% dividend yield, and in a market where investors are happy to be sitting with $12 to $13 trillion of negative yielding debt. The U.S. bank sector looks less interesting, given valuations have already factored in higher growth and interest rates. However, there are a lot of exciting transactions happening in the U.S. life insurance sector as companies are taking advantage of a huge gap between public and private valuations. Some trade as low as 2 to 3 times earnings on an underlying basis. The stocks are incredibly cheap and also benefit from rising inflation and steeper yield curves. And if there's one space more hated than European banks, it might be U.S. life insurance. Lastly, careful selection is required when investing in Asia given the slowdown in the Chinese economy, but we do believe that the Korean and Japanese banks are attractively valued with upside potential as those economies reopen and with banks also poised to ramp up capital return. Korean banks trade on 4 times earnings and have 5% dividend yields with just 20% payout ratios. We think payout ratios will move higher and the stocks will follow, and the Bank of Korea has just started hiking, which is a big boost to their earnings power.
Understood, thank you. Now look, we've discussed internally to some extent the importance of accessing different asset classes via both an active and a passive approach, and clearly we are an active investment house. Now, one way of accessing the financial equity sector is to invest in an ETF. So what are your thoughts on gaining exposure through an active approach rather than via a passive vehicle?
We very much believe an active approach is appropriate for investing in the financial sector. What is important to remember is the global financial sector is perhaps the most diverse, eclectic group of companies out of any sector in the market. It's not at all like tech, where active managers can really struggle to outperform an index which is dominated by a small handful of firms. In financials, you have a huge sandbox of different types of companies within different subsectors and geographies. The key drivers of a Brazilian life insurance company look a lot different from a French bank or a US asset manager or a Bermuda reinsurer. There is just such a broad universe that it really provides opportunities for sector specialists.
And the final question, which perhaps I should have asked at the very beginning, is what would you say to those investors who still feel nervous about financial equities?
So I would say the nervousness is understandable given the volatility the sector experienced coming out of the global financial crisis and over the last decade. It's exactly how investors were feeling nervous about the tech sector for years after the dot-com bust. But this is what creates the opportunity. You don't find alpha in an asset often where there's a large majority of investors who feel very comfortable owning it. In fact, it's usually the opposite. But people are nervous because they are looking in the rearview mirror at a decade of underperformance and balance sheet repair for the banks. The key to positive returns today, as always, is to look forward. The bank's performance during the pandemic is one indication that the worm has turned for the sector. Banks came into it with strong capital and reserves and are coming out of it with even better balance sheets than when they started. And now they are ready to restart their dividends and buying back their shares at very attractive discounts to tangible book value. Banks have been run for creditors and regulators for the past decade, and shareholders have been left in the dust. This is changing as we speak. Investors should not be nervous, they should be excited.
Great, that's excellent. That leaves me to thank Mark for his time and his input, and of course to thank our listeners.
Thank you, Doug, for the opportunity. Look forward to speaking again soon.
I look forward to the next Alpha Horizon episode. And of course, if you have any topics that you would like us to cover and you feel it would be beneficial for us to talk through with any member of the investment team, do please let us know. So until next time.
The Alpha Horizon. Thinking different, acting aware.